From New York City, for our viewers worldwide, I am Scarlet Fu, and right now we're looking at little changed for equity markets on this Friday. You have S&P futures, NASDAQ futures up just slightly, about 0.1% to 0.2%. The Russell 2000 futures indicating a lower open for the moment. The countdown to the open starts right now. Coming up, stocks set to close out a fourth straight week of gains at record highs. We've got the Fed speak extravaganza continuing today. Daly, Waller, and Kashkari are on the docket. And memes become nightmares as the rout in GameStop extends to day 3. We begin with the big issue, which is preparing for higher for longer.
Incoming economic information indicates that it's going to take longer to gain that confidence. So holding our restrictive stance for longer is prudent at this point as we gain clarity about the path of inflation.
All right, let's start our conversation now with Bloomberg's Liz McCormick. Liz, we got the cooler inflation number that everyone was waiting for, and yet when you listen to Fed officials speaking, they're still saying, let's keep waiting, let's keep seeing how things progress. Why is that?
Yeah, it's definitely a unified full court press that they're sticking with higher for longer. I think, they have to, Scarlett, because, we had those 3 bad months of inflation. Now we got one good one. They're seeing some signs of easing, let's say softness, not really soft in the labor market. So, they want to be patient because they want to make sure it's not like a head fake. I mean, that's, to their credit. They have to see a continued trend. We're still far from 2% on their target for PCE. So I think they want to kind of temper excitement a little bit, although like you just mentioned, stocks are doing well, so risk assets are doing well. But I think the Fed just wants to say, hey, the path of least resistance and what's probably going to be good is just keep these high rates, and they are high, for a little bit longer. They don't want to kind of oversell easing coming soon.
Right. Stocks are higher. Also, bonds, if you look at the 10-year, doing well, too. You've got the 10-year extending its rally to a third straight week. Last night, the 10-year yield touched a 5-week low of 4.3%. What is the thinking here that investors are still pushing ahead with this idea that they can continue plowing into bonds even as a rate cut is not necessarily in the cards in the near term?
Yeah, I think they still believe that Fed wants to cut this year. They're going to somehow pull off some kind of cut. I think that's the majority of what traders think, albeit maybe it's only in December. Who knows? Markets price for like September. So I think in bond land, you still have attractive yields. You got decent coupons. And I think what's sure, Scarlett, is that at least it seems as of now that the market doesn't think the Fed's going to hike. The Fed has kind of taken that risk away. So if you're sitting here taking in nice yields and eventually the Fed's going to pivot to easing this year, bonds still look good. Although I did speak to a big asset manager yesterday who does, major asset allocation, and she said, hey, they're moving a little bit out of rates land and overweight into equities because there's better returns there. So maybe there's, people chasing a little bit higher yields in stocks because they've been great returns. But I think bond land people still think you'll get a positive total return this year.
All right, fantastic setup there. Bloomberg's Liz McCormick, thank you so much. Let's dig into this further now with Monica Defend. She is head of the Amundi Institute, as well as Erik Knutzen, multi-asset class CIO at Neuberger Berman. Monica, let me start with you here. When it comes to equities versus bonds, which is in a better position given where we are right now with this higher for longer scenario of the Fed not doing much and just staying pat and monitoring data?
Well, it is data dependent, right? So as long as earnings will continue to prove solid, sitting on solid margins, this might really make the opportunities open to enter into the risky asset more broadly. When it goes to the asset allocation on our side, what I have to say, we are quite selective on the equity side. Europe, UK, balancing between cyclicals and defensive high dividend stocks. While in the emerging market, there are some nice idiosyncratic story that goes to the supply chain relocation or disposal of natural resources. On the bond side, we really maintain quite a flexible duration positioning with a preference, a bias for a long duration one and eyes open on the periphery, which we like at the moment in Europe.
Okay, eyes open on periphery. Let me bring in, of course, Erik for his take. Erik, where do you sit in terms of equity market performance? The big caps have done very well. Semiconductor stocks seem to be rolling over a little bit here, but no one's saying that there isn't more growth prospects coming out of that sector.
Yeah, overall, we want to have exposure to equities in this environment. The fundamental setup remains quite positive for equities with resilient growth, still strong consumers, still strong labor markets. The inflation falling, although probably not as fast as perhaps people thought, but still on a downward trajectory. And central banks determined to shift from hawkish to accommodative at some point, whether it's this year or next. Combine that with fiscal stimulus and lots of liquidity, that's a setup that is still supportive of equity markets. But within equity markets, we want to be biased on the areas that are not perfectly priced for the soft landing. So perhaps down the capitalization spectrum, real focus on quality and business resilience, and in areas that are perhaps more cyclically sensitive and will do better in a higher for longer and perhaps more inflationary environment. Within that context, we would say it's more of a fair fight between equities and, say, short to intermediate term bonds, given the yields available and the risk reward of that short to intermediate portion of the yield curve.
Erik, I'm curious to get your take on what you think of the resurgence of meme stocks this week. They've had an up and down week, 2 days up, 2 days down, and right now it looks like they are going to fall today. What do you make of this? Do you think that this is the start of a new cycle, or is it a contrarian sign?
I think it's just a sign that there's lots of liquidity in the system and with some potential tail risk associated with the extremes of either high inflation or increased risk of recession being kind of taken off the table by some of the data and some of the policy statements, just animal spirits associated with liquidity. You saw, 7% move in Bitcoin the other day. That's just about marginal liquidity and not something that investors should get sucked into. Okay,
understood. Monica, let me go back to you. You mentioned that you're slightly constructive on U.S. duration with a flexible approach. What does that mean? What does that look like?
Well, given the volatility that we've been experiencing on the interest rate market, it has been really difficult to play top-down stories while having in mind that it's true, higher for longer, but we stay on the camp of those who believe that the ECB and the Fed will cut probably when it goes to the Fed even in July. So we are a little bit out of consensus there. And therefore, we've been managing the positioning accordingly with a preference for the steepening of the curve.
We had Rick Reeder on. David Weston spoke with him, Rick Reeder of BlackRock, and he made the point that the rate hikes that the Fed undertook did not necessarily tackle inflation. And the reason is because high rates allow wealthy Americans to earn more on their fixed income investments. And in earning more, they're spending more. And by spending more, they're keeping prices elevated. Does that make sense to you?
Yes, it does. And actually, what we've been doing has been to drill down consumption into consumer cluster. And it is true that is the middle high income part of the economy that is really doing well, but the rest is not. And at this level of rates, they are really suffering. So somehow, as a policymaker, you should take this into account eventually.
And there's a headline there about spot silver rising to $30.43 an ounce, the highest since 2013. Erik, let me bring you in again because commodities, although not as cheap as they were 3 months ago, is something that you are looking at carefully, seeing it as a hedge against inflation spikes. How do you express this? Are you doing this through ETFs? Are you doing this through mining companies?
Oh, it depends on the client mandate and the guidelines of what we're trying to implement. Where we can, we're doing it directly with futures on specifically WTI for energy, gold, and copper, both to create a combination of geopolitical risk hedges and downside risk hedges, as well as inflationary hedges and hedges to the need for more copper, for example, for decarbonization. That'll also help if China has surprisingly strong growth. And also geopolitical shocks, particularly through oil.
You mentioned China, you mentioned geopolitical shocks. We will get to that shortly. Erik Knutzen of Neuberger Berman, thank you so much for being with us. Monica, stick with us. We've got a lot more to discuss with you. Now, in the meantime, let's bring in Abigail Doolittle to take a look at some of the individual movers that are on the move right now ahead of the opening bell. Abby?
Well, we have quite a few of them, Scarlett, despite the fact that the futures are basically flat. Some big movers here, starting off with the shares of Reddit. They are up sharply, up about 11% after they have made a pact with OpenAI to bring content to ChatGPT. Investors seem to like that a lot. Take-Two, on the other hand, the gaming company, well, it's well off of its lows. At the lows, it had been down far more than just 0.5%. But there's some more disappointment around the timing of Grand Theft Auto 6. It won't be coming around until the fall of 2025. And the quarter that was in the forecast, not quite what investors were hoping for. And then, of course, there's GameStop. Now, the stock is still up more than its $10 level or thereabouts before the recent meme rally. In fact, it's a double from those levels. But on the morning, extending 3 days of declines, down about 19%. They missed sales estimates. They came in with preliminary net sales, so basically a pre-announcement here of $872 million to $892 million. The estimate is a greater than $1 billion. And then, of course, there's also the headline that they may sell up to 45 million shares of their Class A stock. That, of course, would offer some big-time dilution. Investors not liking that news at all, Scarlett.
All right, good stuff. Abigail, we will check in with you a little bit later. Coming up, China unveiling its most forceful attempt yet to support the struggling property sector. We're going to have all the details next. This is Bloomberg.
Today, the focus wasn't even on the data. It's about the rescue of the property sector, or the supposed rescue. So that really opens up Asia in particular. If you ask me, where are clients least allocated based on our data relative to benchmark, clearly Asia is where it is. And maybe there's an opening there for flows to redirect.
That was Jeff Yu of BNY Mellon addressing Beijing's rescue package to prop up China's property market and what it could mean for investments in the region. Let's take a deeper dive into those implications. Bloomberg's Enda Curran joins us now from Washington. Enda, first of all, Beijing unveiling its latest measures to resolve or end the property crisis. What are the specific measures it took, and how does it differ from previous efforts?
Well, it's a mix of steps. It includes bringing down payments, for example, and making it easier to get a mortgage by bringing down mortgage rates. There's also about, say, 41 billion US dollar equivalent of money being given to state-owned entities to go and buy unsold homes and in turn then recycle those into social housing and the like. The point is that collectively, it's probably the biggest step the authorities have taken so far on the housing market. It certainly signals a new degree of urgency by the authorities in Beijing. And, this is what a lot of the outside world has been waiting for when it comes to China's economy. A lot of people looking from the outside in have been asking, why hasn't China taken more aggressive steps to stabilise its housing market and turn things around? Data that came out on Friday showed prices fell by the most in month-on-month in a decade over April. Well, this looks like authorities are now starting to pull some levers, at least on that front.
Okay, so taking a bigger, more meaningful step towards resolving the property crisis. However, do these latest measures address the critical issue of a supply-demand mismatch?
Well, I think, look, we're going to have to wait and see how it all plays out and whether or not it does work. But you're talking about a sector of the economy that makes up maybe between 20 and 25% of activity in China. The property sector is a huge multiplier. It's obviously critical. We had data on Friday showing consumer spending continued to go in the wrong direction. At the time, the industrial side of things is doing okay. So clearly, the authorities realise they have to address the housing slump for their own domestic demand story, for their own economy, and if they want to meet their own growth target. There's also a global political angle to it, by the way, because, China's getting criticised for making lots of stuff and selling it overseas because they can't sell it at home. Well, China can now say, look, we're putting money on the table here to stoke demand and to rev up our own consumer base.
Fantastic wrap up there. Bloomberg's Enda Curran with the latest on the China data dump and, of course, the latest measures to support its real estate market. Let's bring back Monica Defend. She is head of the Amundi Institute to talk a little bit more about investing in the region. Monica, you heard earlier Jeff Yu talking about how China and Asia is under-owned by a lot of funds. Where are you when it comes to exposure to China, exposure to Asia?
Well, when it goes to China, we really need to frame it over a longer-term perspective, which makes the rebalancing of the economy credible. What is happening, though, in the short term, obviously, the imbalance, in particular in the real estate sector, is so wide that we need to see more. And this is the step-by-step policy efforts that we are seeing displayed by the authorities. So we welcome what has been done so far, but still, unfortunately, it is not enough. Having said that, since I would say the pandemic, there is this new geopolitical disorder that is allowing nearshoring, offshoring, and in particular, the regions in the neighborhood of China getting track. I'm thinking about India, Indonesia, South Korea. Those countries are really interesting because of idiosyncratic story. Might be the electric vehicles, the green transition, the digital transformation, the availability of natural resources, the supply chain relocation. But what is interesting there is that there are really idiosyncratic story that make the region per se appealing, even ex-China.
Right. Okay. So you got to do your homework, and you can't go in there necessarily with big themes because they don't necessarily apply. You've got to look for companies from a bottoms-up approach. So I'm curious. You mentioned rebalancing, and of course, we know that China has been rebalancing its economy from one that's investment and export-driven to one that is domestic demand-driven for years now. The property crisis really tripped that up. Where are we, do you think, in that rebalancing effort?
I think that they are, if not at the initial stages, at least in the middle. When it goes, for example, to the rebalancing of the real estate sector, on other fronts, such as the energy transition, definitely they are running fast. The geopolitical angle is something relevant. We think the situation with the US will continue to move along the same path, but it will be interesting to see how the relationship with the euro area will deploy. So really, to make there are many bricks that have to stay in the right order to see this progression towards a more stable economy.
What does that mean for Europe, which, of course, has much closer ties in many ways to China manufacturing than the U.S., given the efforts by the U.S. to reshore or to at least nearshore a lot of the manufacturing?
Well, what has happened so far is that we have been seeing more and more one-to-one relationship with China at country level rather than a European response. Probably it will be necessary to have a clear and shared industrial policy in the euro area, which is in the plan, and possibly after the election that will take place early in the summer, we will see what kind of steps will follow.
Got it. Let's talk a little bit about Europe more carefully here. We got the data on inflation. Eurozone CPI, core CPI, rose 2.7% as expected. It does look like European inflation, disinflation, that is coming faster than a lot of people had anticipated, and perhaps the ECB will move before the Federal Reserve. What does that mean in terms of how you position yourself?
Well, whether it is faster, I don't know. Definitely is a disinflation trend that is clear and probably is clearer than in the United States. The ECB has been honestly quite vocal, saying that it's expected now that they will cut rate in June. However, we believe that there won't be much space to diverge from the Fed. So 50 basis points might be in the pot as a divergence between the two central banks. But then if we go beyond that, we might see some inflation coming. Don't forget that oil prices are in US dollars. So the divergence between the two central banks will eventually be reflected on the FX space, cascading down to inflation. So this is the call when it goes to monetary policy. When it goes to the equity market, it is interesting because given that we see the central banks start cutting rate, the cycle recovering, there might be some pockets in the market, small cap, for example, that might be appealing.
All right, good stuff. Monica Defend of the Amundi Institute, thank you so much for joining us on the Open. Coming up, we've got the morning calls, and a little bit later, a preview of Boeing's annual shareholder meeting set to begin in a few hours. Gabelli Funds Portfolio Manager Tony Bancroft sets the stage ahead of discussions. That conversation's still ahead. This is Bloomberg. This is the countdown to the close, to the open, excuse me. I don't normally do the open. I'm Scarlet Fu. Let's take a quick look at markets right now. Futures indicating a mixed open, and certainly when you look across the size scale. But for big cap stocks, we're looking at modest gains. The S&P futures up about just marginally 2 points. NASDAQ futures up by 0.1%. And this is, of course, after the major indexes closed at record highs on Wednesday. Russell futures right now indicating a somewhat lower open. Let's take a look at what's going on in bond land. You've got moves higher in yields, whether it's the 2-year, 10-year, or 30-year, just marginal moves here. In any case, for the week, the 10-year yield is set to the 10-year is set to rally for a third straight week, which means, of course, yields move in the opposite direction. 10-year yield actually yesterday touching 4.3%, a 5-week low. Let's get you now our morning calls. This is a look at some of the analyst recommendations this morning. And first up is Wolfe Research upgrading United to outperform, highlighting the company's impressive fundamentals and strengthening domestic travel trends. Next up is BTIG upgrading Darden to buy, touting the restaurant operator's attractive dividend yield and compelling valuation. And finally, Bank of America upgrading Robinhood to buy from underperform, the analyst raising shares by 2 notches, given the recent surge in retail engagement. Now, coming up, we are looking ahead to Boeing's big shareholder meeting. That conversation is up next with Tony Bancroft of Gabelli Funds. In the meantime, the opening bell is up next. This is The Open on Bloomberg. This is the countdown to the open. I'm Scarlet Fu. We're just moments away from the start of trading, and futures indicating a mixed open at the moment. This, of course, after indexes closed at record highs on Wednesday. The Dow yesterday did pierce 40,000, but couldn't hold on, and so we did close lower. There's no real meaningful economic data on the board today. We do have LEI at 10 a.m. after the open. We do have Fed speakers as well, so we'll bring you those headlines when we get there. Let's change up the boards and take a look at how other asset classes are performing. You do have euro dollar moving lower, marginally so, at 108.55, excuse me. The 10-year yield also not doing a whole lot, 4.39% at the moment. Of course, there's a lot of caution after the excitement of this week's cooler CPI print, and Fed officials have made clear they want to stay higher for longer and monitor the data. New York crude also moving marginally higher, still below $80 a barrel. Now, one stock to watch at the open, GameStop. The shares extending their drop to a third day after posting disappointing results and announcing plans to sell up to 45 million in shares. Abigail Doolittle has more. Abigail.
Well, over the last 3 days, Scarlett, we now have the shares of GameStop down about 70%. That, of course, after in the month of May, from the beginning of May to the recent peak on the meme rally sparked by Roaring Kitty, up 500%. So lots of volatility for the shares of GameStop. Now, earlier this morning in the pre-market, both GameStop and AMC had been higher, but then the news came from GameStop, essentially a pre-announcement to the downside for their first quarter. They are saying that their preliminary net sales are going to be between 872 million and 892 million. The estimate just a little bit above 1 billion. That sent the stock lower. And then the additional news that came out is that they may sell up to 45 million shares of their Class A common stock. They basically filed for this, and they could do it through Jefferies as their sales agent. They said that their plans to use any net proceeds from the offering for general corporate purposes. Now, of course, AMC earlier this week had already had the filing in place to be able to take advantage of the rally. So they did some moves with their capital stack. GameStop had not had that in place, but now they are making this announcement. And of course, the fears of dilution, the stock down 21% again. This stock over the last 3 days down 70%. And into the sell-off, Scarlet, in the month of May, the stock had been up 500%. Lots of volatility, not for the faint of heart.
Absolutely, a clear roller coaster ride there. Thank you so much, Abigail. Let's stick with entertainment because Take-Two, the video game publisher, giving weak full-year guidance and announcing the highly anticipated Grand Theft Auto 6 will not come out until fall 2025. Simone Foxman has more on this one. Simone?
Yeah, Scarlett, talk about a roller coaster in shares. We initially saw in the post-market yesterday shares of Take-Two fall about 10%, and then it kind of recouped some of these losses. Now we're looking at shares that are higher this morning after that release date was announced. Now, interestingly, this will put the release in fiscal year for Take-Two 2026. That is why the company was forced to report guidance that is lower than expectations, $5.55 to $5.65 billion. A year ago, it had estimated full-year revenue for the 2025 of $8 billion, and the consensus had been around $7 billion. But Grand Theft Auto 6, expected to be one of the highest grossing video games of all time. There was a report in March that it could be delayed into calendar year 2026. So we are seeing some enthusiasm here that it's not going to be that date. Morgan Stanley calling the delay to Grand Theft Auto 6, removing a major overhang in the shares. And Deutsche Bank says it sees strength in its other businesses. That was part of the reason we saw pretty decent fourth quarter earnings. And Deutsche Bank also saying that the long-term opportunity it believes for Take-Two remains intact. Scarlett.
So the release date gives a little bit more certainty to something that was a big question mark. Simone, thank you so much. Let's turn now to the chip industry. Applied Materials did not exactly impress investors with its latest forecast, following a rally in the shares this year. Isabel Lee has more on this one. Isabel?
Hey, Scarlett, this is an interesting stock to watch because in the pre-market, it was trading lower. Yesterday, it was also down, but now shares are popping. So I guess investors are still digesting the news. But then you're right. The company did give out a forecast that failed to live up to investors' extremely high expectations. And so Applied Materials is the largest maker of chip-making machinery in the U.S. So this is typically seen as a bellwether of the chip industry. And it reported actually sales the top average estimates, and profit range was also in line. But to your point, it was really the outlook that failed to impress. And we have the CEO saying that near term, expect some digestion, that they're not expecting that it will be a significant growth year this year. But he also did say that he's extremely bullish about the prospects of AI chips. Investors really have been looking to Applied Materials for any sign that the chip industry is recovering. Applied Materials supplies to the industry's biggest manufacturers. This includes Samsung, Intel, and TSMC. But Morgan Stanley, though, is not that pessimistic. The company reiterated its equal weight rating and saying that they're impressed with the firm's execution, that they don't see an imminent negative catalyst with China spending. We have also Citi raising its price target and maintaining its buy rating. For now, shares are holding up around 2%, and year to date also up around 30%, Scarlett.
Yeah, I look at the Philadelphia Semiconductor Index, and Applied Materials, the second best performer at the moment. Isabel, thank you so much. So from chips to social media, Reddit announcing a partnership with OpenAI that'll bring its content to ChatGPT and new AI features to its forums. Ed Ludlow has more on this one from San Francisco. Ed.
Good morning, Scarlett, and welcome back to the morning. You know, it's interesting. Reddit's clearly markedly higher, around 10%, flirting with a fresh record high since its IPO. It's actually a two-way relationship. So OpenAI will get access to Reddit forum text data in order to train its models, but it'll also be able to show Reddit posts through its consumer and enterprise-facing chatbots, essentially. What does Reddit get out of it? Well, Morgan Stanley estimates anywhere from $40 to $50 million of very high margin revenue every year. So that's clearly a boon. But also, Reddit's talking about offering its own AI tools within the Reddit forum that are built on OpenAI's large language models. So it's not the first type of licensing deal Reddit's done. They have one existing one with Google, and they've kind of been like super disciplined. Every time I speak to one of the executives, they say, oh, it's very early days. It's an early market. We're still an advertising advertising-based business, but clearly the market sees a lot of potential in this. And what's so cool about Reddit information is it's kind of like real time, right? It's a snapshot of what actual humans are saying about all kinds of stuff, as opposed to kind of historic backwards looking text data that training large language models usually entails by going through databases or through the internet, essentially. And so on the other side of the table, those building the large language models see a lot of value in Reddit. The question for the street and the sell-siders in particular is, well, that's really good. When's the next one? How many more of these can you do?
Yeah, well, Reddit delivering on what it had told investors it would do, which is get into licensing its data. And of course, ChatGPT will need to learn how to decipher a lot of acronyms. Ed, thank you so much. Now, another stock to watch right now is Boeing. It is lower in the early trade right now, losing about 0.25%. The company holding its annual shareholder meeting today. Joining us now for more is Tony Bancroft, portfolio manager of Gabelli Funds. Tony does own Boeing in his portfolio. So, Tony, this annual shareholder meeting is going to be held virtually. There's a lot on the agenda, from safety issues, of course, to CEO pay, to a CEO search, to the election of board directors. What is most urgent for you?
You know, I think all those issues are important, timely issues. But I think the big picture is Boeing. Number one, they need to hire a new CEO now that they've announced that CEO Calhoun's going to be stepping down. Number two, they've got to get the Spirit acquisition done. Number three, they've got to get production rates, for the 737 back up and back to where investors expect. And number four, they've got to get the 787 deliveries, production rate, and supply chain squared away. And I think that those are the real four material items that are going on in Boeing's world. And the stock's probably going to be in high volatility until that point.
Okay, so of those big issues, what are you likely to learn the most about at today's shareholder meeting, do you think?
You know, I think it's going to be very formulaic in a sense of they'll go through what the agenda is, and they'll vote, however proxy voting committees will vote and go with recommendations. Our proxy voting committee has its view, and I think most of it will probably be along those lines. I'm sure there will be issues coming up from the recent January 5th incident, and among other things, the Spirit acquisition as well.
Okay, so let's talk about the CEO search. There's a question about whether Boeing needs to go outside the company for its next leader. The problem is the underlying businesses are not really easy for outsiders to master. You've got complex engineering, high volume manufacturing, and of course, now, well, I shouldn't say now, but high safety standards that may have been a concern up until recently. You cover the aerospace and defense industry. Can this leader, this kind of leader, only be found in peers, in rivals?
I think you probably can make a case for both sides of that argument. You can probably find highly successful companies that have had obviously insiders, people that are outsiders but within the industry, and then complete outsiders and show extreme success. I'd say maybe specific to the aerospace and defense industry, maybe even specific to Boeing, just because they're the largest commercial plane manufacturer. You probably want someone that has a background in the commercial, or defense aerospace industry, someone that understands, pretty technical, highly engineering components. So, but with that being said, there's probably a lot of options out there, and I think Boeing probably has a lot of great, candidates that they're looking at right now.
Okay, Tony, have you added or trimmed your position recently? If not, what are you more likely to do, add or trim?
So I've been slowly adding to my position, and over the long term, I'm still a long-term buyer on Boeing. We think that the secular trends, the tailwinds that the industry has on both sides of the commercial aerospace side, the aftermarket side, and then the defense industry, you're just going to see continued secular growth on both industries going forward, just with all of the geopolitical instability and just demand for travel with this experiential generation and the emerging economies wanting to come to the middle class.
So, I mean, doesn't that get to the gist of it, which is despite all these issues, despite the long to-do list that Boeing has to tackle, demand for its airplanes remain intact, and that's not going anywhere anytime soon because you've only got Airbus as the alternative.
You know, I mean, I don't think you could have said it better, Scarlett. You know, through the pandemic, which was the worst downturn in, commercial aviation, Boeing and Airbus essentially had net increases in their backlog. So I just think there's something to be said there about that. And in all reality, for all intents and purposes, it's going to remain a duopoly for the foreseeable investable future. So I think there's a lot of barriers to entry, and there's a lot of reasons to want to own these two, to own the OEMs and to own just the aerospace and defense industry in a whole.
Tony, before we let you go, if there's any room for surprise in today's shareholder meeting, what might be the surprise?
I'm sure there could potentially be a surprise with people voting against. I mean, but it's really not a surprise because both of the proxy have sort of offsetting views. But you could see, maybe people, not voting against maybe what the general thought was of the board or CEO pay. But I think in the long run, that's not the factor that's going to change anything for Boeing in the long run.
All right, got it. Tony Bancroft of Gabelli Funds, thank you so much for joining us with a preview on Boeing's shareholder meeting that begins in just over an hour. Coming up, the advancement of generative AI continues.
People are continuing to see the advancements. We haven't stood still in Gen AI. I think lots of things are happening there so people can extrapolate about the productivity improvements ahead.
We take a look at the world of AI next. This is The Open on Bloomberg.
This week, we continue to see lots of interesting news on Gen AI, right? Project Astra, have you tried ChatGPT 4.0, right? So some of the power of these applications is still to come, and I think that will encourage investors.
That was Nancy Curtin, Alti Tiedemann Global CIO, speaking to Bloomberg earlier this morning. Of course, this comes ahead of a big week in tech. NVIDIA reporting earnings next Wednesday. Let's bring back Bloomberg's Ed Ludlow for more. Ed, you're in San Francisco. NVIDIA is the one thing that everyone's paying attention to. Earnings season is largely over, but if you want to get a snapshot of where demand for AI is coming and what it looks like in the coming months, you can look no further than NVIDIA.
Yeah, that's right. And the timing of it at the end of the season is kind of interesting, right? Because it's the mainstay of everything that's happened. It underpins the infrastructure build out we're seeing. With NVIDIA's earnings on the 22nd, it's super important to just simplify the story. And the story right now with AI is that NVIDIA accounts for the majority of the market of AI accelerators, high-performance GPU that can run lots of data processes in parallel. But those data processes are being run in only one place. That is the hyperscalers, the large cloud market leaders, principally Amazon AWS, Microsoft Azure, and Google Cloud, which has some of its own silicon as well. And so a big question that everyone has is like, hold on, there's billions of dollars here only going to one place. But there are loads of people training large language models or that would want to and do it just at a smaller scale. And so that's the next step of the evolution. When does NVIDIA and all of the tech partners it have take that tech and kind of give it to SMEs, small governmental arms, and send it a little bit down the chain? And that's what we'll look for the commentary on in earnings.
Okay, fantastic thing for us to look ahead to when it comes to NVIDIA's commentary. You and your colleagues who cover the technology industry for Bloomberg have talked this week about the prospect of M&A in the AI space. And we saw some of that with Snowflake in talks to acquire the startup Rika AI for more than $1 billion.
It's a really interesting $1 billion deal. And as you say, it's very timely. Basically, every conversation I'm having is that consolidation's coming, particularly for the smallest or weakest of AI startups that are running out of cash. they are spending a lot on compute to train models, and they're running out. But also the other side of that story is that big tech's kind of sucking the oxygen out of the room. Cue Snowflake and Neuberger AI, and that's exactly what's happening. Snowflake's acquiring what is a maker of large language models. It has a classic AI backstory, which is that it was founded 2022 by ex-Meta and ex-Google researchers, so common, particularly in this part of the world. And Snowflake kind of sits on that layer above cloud computing, just as, say, a Salesforce does or a Databricks does. But you see increasingly those bigger cloud-based software names want to have their own LLM competence. And acquiring them is one way of doing it. And it's an interesting read on the Bloomberg for sure.
Yeah, definitely. And of course, the smaller you are, I guess there's less of a risk that the regulators are going to come after you. Certainly, if you're the biggest big tech companies, doing so will raise the ire of the FTC and the DOJ.
Yeah, I still reckon that we should keep our eye out for some M&A or the prospect of M&A being looked at this year. But yes, and at the same time, the other part of the NVIDIA story is that NVIDIA's training its own models and sees itself as a one-stop shop. So all of the sprint of the last year for companies big and small to say, I'm going to train my own model, whether it has millions, billions, or tens of billions of parameters, maybe that was a bit overdone, and that's a part of the consolidation. Too many people were trying to do the same thing.
Yes, absolutely. Bloomberg's Ed Ludlow, great context there. And of course, Ed will be very busy because on Monday, he'll be at the Dell World Conference in Las Vegas, where he will be joined by CEOs of some of the biggest names in technology, including the NVIDIA CEO, Jensen Huang. Now, for some of the sector price action this morning, let's get over to Bloomberg's Abigail Doolittle. Little change on the day, but movement within the sectors, Abigail.
Very little change on the day. Right now, we are literally flat, slightly to the downside for the S&P 500. But yes, we do have a number of sectors on the move. Right now, slightly more to the downside, led by consumer staples, but down just 0.3%. So not a lot of movement there within those down sectors. And similar story to the upside. Materials, the best sector, up about 0.4%. So it seems as though investors are a little bit tired. We, of course, are looking at a 4-up week streak in a row for the S&P 500. On the week, most sectors are higher, led by technology. But earlier, of course, we did have the breaking news on silver hitting its highest level since 2013, back above $30 per ounce. We have this rally for metals, perhaps because metals, gold and silver and copper, for that matter, do well, whether there's an inflation story or if the Fed does cut and turns a little bit dovish. And we also had some interesting news on Microsoft, a report saying that they may be changing the way that they charge for their Call of Duty game, that it will be a subscription model, Scarlet. That stock, very little changed on the day, actually down a little bit. But on the week, we can see that tech is higher, up again about 3.3%, up for a fourth week in a row.
All right, good stuff. Abigail, thank you so much for the latest there. We'll be keeping an eye on the moves across the equity markets. Coming up, the market moving events that you need to be watching for next. Our trading diary is up next. This is The Open on Bloomberg. This is Bloomberg's The Open. I'm Scarlet Fu, taking a look at markets about 30 minutes after the start of U.S. trading. Flat on the day right now. The Russell 2000 is the only one that kind of has a direction, up by 0.1%. The Nasdaq 100, little change. The S&P 500 unchanged. And of course, this comes after the Nasdaq, the S&P, and the Dow closed at record highs on Wednesday. Time now for the trading diary. This is what you need to be watching for the rest of the day through next week. We've got Fed Speak ramping up with Waller and Kashkari at the top of the hour. We'll bring you the headlines as they cross. Boeing hosting its shareholder meeting later this morning. It'll be virtual, helmed by the chairman, Steve Mollenkopf. Investors will be seeking updates on its search for a new CEO to succeed outgoing chief Dave Calhoun. Then moving to next week, we get more Fed Speak from Bostic and Barr on Monday. followed by Barkin, Mester, Williams, and Collins on Tuesday, and NVIDIA earnings coming after the closing bell that day. And finally, watch out for the Fed minutes on Wednesday. This was the Countdown to the Open.